Swayam Prabha. Digital India. Educated India.
Last 2-3 sessions we are discussing about one of the very important statements known as cash flow statement. Today we will do a few more problems on the same, followed by a slight variation known as funds flow statement. Before going for more problems, let us see what do you understand by cash flow statement. To have a brief recap, do you remember what do you see there? Perhaps you will be remembering that cash flow statement, as the name suggests, gives a flow of cash and cash equivalents, and the flow gives categories of money coming in and going out. There are 3 categories. One is operating flows. So these are the flows from day-to-day business operations. Second are investing flows. As the name suggests, this is the money which is invested either in fixed assets or in buying securities of other concerns. So either buying or selling of fixed assets, purchasing of shares, selling of shares, receiving interest, all these items are covered in I, that is investing flows. And the third are financing flows. This is the way the business has raised the funds. So obtaining loans, issuing shares, or redeeming shares, repaying loans, all these are covered as financing flow. So if you take total of O plus I plus F, we come to know what is the total cash received by business, and that should match with the increase in the cash balance, which is at the beginning and at the end, both are given. Okay. So let us do few more problems today, and we will also do funds flow statement. Okay, have a look at a new problem. So here you have a balance sheet of RK Limited, and based on balance sheet you have been asked to work out cash flow statement. Now first tell me, how do we start? They have given a balance sheet, they have also given profit and loss account. A solution is also given, but we will ignore that solution for the time being. We will try to solve it all our own. Yeah, anybody has a suggestion? Exactly how do you start for making the cash flow statement? Okay, I think most of you are getting it right. First what we do is we look at the changes in the balance sheet. Considering the changes in the balance sheet, we try to mark them as O, I or F, and based on that marking, we will go ahead in making the cash flow statement. Now the first item, you have got equity share capital. So if we start from liability side, so what it is going to be? Is it O? Is it an operating item, investing item or financing item? Anyone has any suggestions? I'll just try to make some space for us to specify, because last time we have done this, but that time we had done in a vertical format. Now we are trying to understand to do it using a horizontal balance sheet. So equity share capital, under what category should I put? Anyone would like to comment? Is it a operating flow, investing flow or financing flow? It is F, that is financing item. Should it be marked as inflow or outflow? You can see there is an increase in the capital from 2.5 lakhs to 4 lakhs. So money has come in. So it's an inflow. F inflow, I have marked it that way. Debentures, what type it is amongst OIF? You are right, again it is a financing flow, because raising money by way of debenture is one of the examples of generating funds for the business. And is it an inflow or outflow? You can see the balance has gone down from 2 lakh to 150. So it is not an inflow, it is an outflow for the concern. So F outflow. P&L account. Should it be marked as a flow, and if yes, under what category? You are right, it is a operating flow because it represents the day-to-day business activities, and it is basically an inflow for the concern. Bank loan. Bank loan, again balance has gone down from 1 lakh to 75,000. Bank loan is also one of the ways of financing. So, I will mark it as F. And is it an inflow or outflow? Since the balance has reduced, we have paid bank some money. So, it represents an outflow. So, it is F out. What about creditors? Creditors represent day-to-day activities. So, it is an operating item, and you can see the balance of creditors have increased. So, is it an inflow or outflow? Can you guess? So, you can give a thought that way. If stock increases, we pay money, so stock increases. In case of debtors, in case of creditors, when the balance increases, it represents an inflow. So, it is again O in operating inflow. Now, let us go to asset side. I will shift this pretty inside so that we can concentrate on assets. Okay. Now, have a look at machinery. You can see a balance has increased from 4 lakh to 7 lakh. What type of flow does it represent amongst OIF? You are right, it is an investing flow. The money represents the investments made by business in the machinery. Is it an inflow or outflow? You can see it is an outflow because the money has been invested. So, from 4 lakhs, the balance of machinery has increased to 7 lakhs. So, it shows that there is an investment made. Land again same thing, it is I, and it is an outflow because the balance has increased. Cash is a different item, it is neither an inflow nor an outflow, it represents the balance at the beginning and at the end. So, we will just mark it as cash. Debtors is O item because it is a day-to-day item. The balance of debtors has gone down from 85 to 70. So, what does it show? The balance of debtors, the balance has gone down from 85 to 70. That means you can say that debtors have paid us some money, that is why it is an inflow. In case of current assets, you should know that increase in the current asset represents outflow, decrease in the current assets represents inflow. Right now, since the balance of debtors has decreased, it is an inflow. Last one is closing stock or inventory. Again, it is an O item. Now, the balance has increased, so it represents an outflow. I hope you are all getting all the items. Now, let us look at P&L items. We have seen most of the balance sheet items. Now, come to P&L items. So, sales, interest received, dividend, all are given. Let us start with sales. What will you mark sales as? I will just try to push it this side. Okay. What will you mark for sales? Any guesses? OIF. It is nothing. You should mark it as XX because it is neither an inflow nor an outflow. It is a day-to-day item. So, we do not record it in the cash flow statement. Interest received, should it be recorded? It should be recorded because we receive interest when we make investment. So, it is an investing flow, but it will have some impact on O, that is operating items also. Interest received represents an inflow. So, I have marked it as IO and inflow. Dividend income, Again same thing, it is an IO because it's an inflow from investment, but it has some impact on operations. So, I have marked it as IO and inflow. Now, let us go to expenses side or debit side. Now, cost of goods sold, how will you mark it? It is nothing, it is just XX because it has no impact on cash flow. Depreciation, it will need to be recorded because depreciation, though in itself is neither inflow nor outflow, it has some impact on operating items. So, mark it as O. It also has some other effect, we will discuss it later. Office expenses, how will you record? Which type of item it is? It is nothing, it is just an XX item. Debenture interest, shall I record it? Yes, because when we raise money by way of debentures, we have to pay them interest. So, it represents a financing item. It will have some impact on O also, and it represents an outflow. That is why I have marked it as FO, outflow. Income tax, shall it be considered? Yes, it is an operating item. So, initially it will be added and again it will be shown as an outflow. Interim equity dividend, it represents the money which business has paid, that is paid to shareholders because we have raised funds from them. So, it represents a financing item, it is F. It also has some impact on O because it has some impact on operating items and it is an outflow. So, it is FO, outflow. And net profit, what does it represent? Net profit is again O. So, let us have a view at all the items once again. You can see some of the items have come 2 times. For example, P&L account. P&L account, the balance of P&L increased from 3 lakh to 589, that has increased because of net profit for the year, which is 289. So, we do not have to take these items twice, they actually represent one and the same thing, this and this. I hope it is clear to you. Okay. So, we will first start with balance sheet items, wherever required we will make an adjustment. So, now we have made all the recordings, let us go to cash flow statement. First we start with the operating items. So, we have a retained profit of 2,89,000. The item comes from balance sheet. You can also see it in P&L, but do not take it 2 times. You have to just take it once. I will try to solve it along with you. So, we will start with, as you all know, the first heading is cash from operating activities. Now, look at all the O items which we are going to mark. So, the first O item which we will start with is the profit and loss account balance, that is known as retained earnings or increase in P&L account. We will write it in the inner column. The amount is 2,89,000. To this we need to add the income tax. If you remember, basically we take profit before tax. To this we also need to add interim dividend. So, these 3 together gives us the profit before tax earned during the year. This I have written in the inner column of our cash flow statement. Now we can make various adjustments. Take a look at other O items. If you remember, the first item which we do is we add depreciation. Why do we add depreciation? Do you remember? Because it's a non-cash item, so we don't have to pay any cash, but it is deducted from profit while calculating the profit. You can have a look at P&L. You will see that depreciation of 31,000 was reduced for calculating profit, but since it's a non-cash item, we have to add it back because that represents the cash which is earned by the business. So add depreciation. Second, we have to make some adjustments. Do you remember which adjustments we make next? We make adjustments for non-operating items. So we do have items which are there in P&L, but which actually are non-O. They have to be I or F. So take a look at P&L. You will see that on credit side we have interest received and dividend, which are received, but actually they do not represent the P&L items. So the amount of 62 and 39 is taken. Now the question is whether they should be added or deducted. You are right, since interest received is our income, we many times feel it should be added, but actually it is not right. What we have to do is we have to deduct it. Why we have to deduct? Anyone can guess? What happens is these items have been already added when calculation of profit was done, but actually they represent I, that is they represent investing flows. That is why they should be deducted while we are trying to calculate operating flows. Now on debit side also we have got item known as debenture interest. So this represents the interest which is paid on debentures. So I will have to consider it. Should it be added or deducted? Now it should be added because it was already deducted while calculating P&L account, but since it's a financing item, we need to add it back. There is also an item known as interim dividend. So should I add it or deduct it? Interim dividend also represents the amount which was deducted. So I will add it. But if you observe keenly, it has already been taken while calculating retained earnings. So you don't have to take it twice. Be careful about this item. That is why I have shown that it should be taken, but it should be taken only once. So we have already adjusted it while calculating PBT. So don't adjust it again. So I hope you are clear. So what we have done now is we have taken first calculated PBT, then we have done adjustment number 1, that is add depreciation. Adjustment number 2, we have adjusted for non-operating items. There is one more adjustment required. Can you tell me which adjustment is adjustment number 3? Any guesses? I think most of you would have guessed it correctly. This is the adjustment for current assets and current liabilities. So current assets and current liabilities actually represent operating items, but they do cause indirect effect on the cash in the hand. So we will adjust for them. Now we will have to go to balance sheet. If you look at balance sheet, on asset side, we have got two items, debtors and stock, and on liability side there is one item known as creditor. So these items need to be adjusted. So first let us start with debtors. Okay, debtors, you can see here there is a difference, reduction from 85 to 70. So I should account for the difference only, I cannot take the whole figure. So there is a fall of 15,000 and it represents an inflow. Stock, So stock, there is an increase from 40 to 65, it represents an outflow. Why it represents an outflow? Because I must have paid cash to get stock, so it is an outflow. By the same logic, I have received cash from debtors because the debtors balance have received come down. That is why debtors was an inflow, whereas stock, there is an increase in balance, so it represents an outflow. So I will take the difference. So minus 25,000. Now take a look and liability side, there is an item known as creditor. So creditors, you can see there is an increase in the balance from 14 to 29. It represents an inflow. I hope it's clear to you. So from 14 the balance has increased to 29. It is an inflow. So all the three adjustments are over. We have done adjustment number 1 for depreciation, adjustment number 2 for non-operating items, and adjustment number 3 for current assets and current liabilities. If all the adjustments are over, we can take sum of PBT with all these items. This represents the cash from operating activities. Now we will go for the next heading. What is the next heading? Yeah, you are right. It represents cash from investing activities. Now take a look at balance sheet. We would have marked some items as I. They are basically investing. First is machinery, next is land. So if you start with the first one, that is machinery. So there is an increase in the balance from 4 lakh to 7 lakhs, which represents an outflow. This is very common sense. The balance of machinery has increased. So naturally we have paid some money, but there is a catch. If you see, there is a difference of 3 lakhs. There is an increase of 3 lakhs. But it is not necessary that this 3 lakh is all your outflow, because we also have to make some adjustment for depreciation, because the balance has increased by 3 lakhs, but there is also depreciation of 31,000 which we will have to add here. So the total increase in the machinery is 3 lakhs 31,000. And this is nothing but a outflow for me. I hope it's clear to you. So what has happened is, we have purchased machinery of 331. Of that, 31 of depreciation goes away. The balance increases by 3 lakhs. So I will record as outflow 3 lakh 31,000. Next item is land. Land, you can see again there is an increase, but this is relatively simple, because all the increase in land is nothing but an outflow. There is no problem of depreciation. So land increase is an outflow. Okay. So minus 62 has come because it's an outflow. Now take a look at balance sheet. All the items are, I think, covered. Balance sheet items, nothing of I has remained. Now take a look at P&L. So P&L, see if there is any item which is marked as I. So you will observe two items. One is interest received and other is dividend income. So I will just paste them first. So interest received was 62,000. It is an IO. We have already adjusted it in O. It will be also it will be shown as I. You all know it's an inflow, so there is no need to find any difference. 62,000 is received by way of interest and 39,000 is received by way of dividend. So if you take sum, you can see that overall minus 292 is a position as far as investing activities are concerned. Now let us go to the last heading, which is nothing but financing activity. Now go to balance sheet again, look for F items. You will see on liability side there are 3 items: equity capital, debentures and also bank loan. So they represents the money raised by the business. Let us start with them, and there could be some items from P&L as well. So if you look at F items, I will just remove this P&L. So there are 3 items now. So there is an increase in the balance of equity capital. It represents the equity shares issued, which is nothing but an inflow. So F inflow. As far as debentures is concerned, there is a decrease in the balance. So debentures have been redeemed, money has been paid, so it's an outflow. And bank loan also, there is a decrease from 1 lakh to 75,000, so it also represents an outflow. So minus 50, minus 25. Now take a look at P&L. There you will find there are 2 items of F. One is debenture interest and second is interim dividend. Let us consider them. Okay, we have 2 items. One is debenture interest, other is interim dividend. You already know that we have to pay interest, so it is nothing but an outflow. That's why it's a minus figure that we will consider. So minus 25,000 and minus 70,000 represents the flow under investments. So now we have all the 3 totals in front of you. You have got total of operating items, which is 267, then total of investing, which is minus 292, and total of financing, which is minus 20. Now if we take the sum of all these items, we will come to know the total money which the firm has raised, which is 55,000. We have to cross check it with the cash. Now look at the position of cash. So cash is 19 and 26. So you will realize that something is missing. Now have a look at different items which are there in P&L or in the balance sheet, whether we have missed anything. Let us find the difference of cash. So it is very clear that there is an increase of 7,000 in the year, whereas we are getting the total of 55,000. So there are some items of 48,000 which are leading to difference. Now let us have a look at what has gone wrong. One by one, look at all the items. Ensure that in case of balance sheet, items are recorded only once. In case of other items, they are recorded twice. So equity capital, it is an F item, it is an inflow. See whether it is correctly recorded. I think it's correctly done. Then debentures, F outflow, it is correctly done. The third item is P&L account. P&L, you know that there was an increase of 289 which has been correctly recorded. Next is bank loan, there is an outflow. So bank loan 1,75,000, so there is an outflow of 25, again correctly done. Creditors, so creditors, you know the balance has increased, which shows that we have paid less. So it is an inflow for us. So you can see creditors, it is shown as an inflow. So these are the items on liability side. Now take a look at items on asset side. So machinery, you can see machinery, there is an increase. So it's a I inflow. Have a look at investing activity. Machinery is increase of 3 lakhs. We have also made adjustment for depreciation. Now look at the depreciation, 31,000. Now this is a non-cash expense. So what will happen is we will add depreciation here, and we are also adding it in investing flow. So what is happening is machinery balance has increased by 3 lakhs despite depreciation of 31,000. So actual purchase of machinery is 331. So you can see that 31,000 was in a way deducted in the investing flow and it has been added in the operating flow. So, again it has been correctly dealt with. Now, look at land. Land is an investing item. So, difference of 62 represents the purchase of land, which is again correctly recorded by us. Cash, you know there is a difference of 7,000 that will come in the end. Debtors and closing stock, this represents CA and CL. So, we have taken them in the operating items. The debtors balance has decreased, you can see from 85 to 70. So, it represents an inflow, whereas closing stock balance has increased, which represents an outflow. So, we have taken all items from here. Now, take a look at P&L items. Interest and dividend received, this should be marked as I inflow. So, interest received and dividend income both are inflows. Now, on debit side of P&L, debenture interest and interim dividend, they are F outflows. Take a look under financing flows, both have been recorded as outflows. Okay. So, these are F outflows. Now, each of the P&L items will have second effect in the operating flows. So, now you can come to cash flow from operating activities. You will see that interest received has been deducted, dividend income has also been deducted. Now, debenture interest has been added and interim dividend has been added. Now, only one item which we have added, but we have not adjusted anywhere is income tax. So, income tax we have added because we want to calculate profit before tax, but in the end we have to pay income tax. So, that is something which we had missed, which you have to record now. So, if you take sum of all these items, it comes to 367. We have to go for less income tax, because income tax paid is an outflow. In this case, you can see there are two effects done for income tax. So, income tax was once added because we want to calculate PBT, and again it is shown as a deduction because it represents an outflow. So, it is 319 is the funds from operations, then we adjust the investing activities, which is minus 292, and financing activities minus 20. Now, you can see the difference comes to 7,000, which is exactly the difference in the cash. I hope you are getting clear. This is how you have to reconcile. In case you are not getting the answer which is equal to difference, you have to go back, look at all balance sheet items, look at all P&L items, and you will come to know where you have gone wrong or which item you have missed. Okay, so here this 7,000 represents cash generated by business, or you can simply say cash generated, which is 7,000. I will make it bold. To this we add opening balance of cash, which we know is 19,000, and now if you take sum, it will be equal to closing balance. So, closing balance of cash is 7 plus 19, 26, and that is the correct amount as per balance sheet. I hope everyone is getting clear. Okay. Now, with this I think we have got sufficient practice now of various cash flows problems. Let us go to a new concept, slightly modified concept of cash flow, that is known as fund flow. Okay. So, I will stop the problems here. Let us go to PPT on fund flow statement. Okay. Now, before we go for more details of fund flow, let us try to understand exactly what is the difference between cash flow and fund flow. Both the statements are quite similar in nature. In cash flow statement, we focus on flow of cash. In case of fund flow statement, we focus on flow of funds. Now, what is funds? Funds are nothing but day-to-day capital available with us. So, instead of only looking at cash, we look at all the monies which are available for day-to-day operations, which are nothing but funds flow. So, in cash flow, we used to list all the ways the money is, the cash is coming in and going out. In case of fund flow, we will look at different ways in which working capital is coming in and going out. There is no categorization made in the fund flow statement like say operating, investing or financing. We simply list inflows on one side and outflows on other side. So, let us see what is fund flow statement a little more in detail. So, what is the meaning? It is defined as a statement which summarizes the sources from which the funds are obtained and what are the uses to which they are put. Now, this chart shows you some of the examples of funds. So, sources are fund from operations, sale of fixed assets, issue of cash. Applications could be purchase of fixed assets, purchase of investment, increase in working capital and so on. Now, what was a need to have such a statement? We have already seen at the time of cash flow statement that though we have a P&L account, it shows the profit for the period. It does not show exactly how the cash has moved. Same way, it also does not show how the funds have moved. So, fund flow statement seeks to show what is the movement of funds in that particular year. We also have a balance sheet, but it is a positional statement. It gives you financial position as on a day, whereas funds flow statement is trying to show from how the money was raised and how it is invested or how it is utilized. Now, how to prepare it? It is very similar to cash flow statement. We take a look at balance sheet, we find out where the differences are. So, we come to know the changes in the working capital and also changes in long term assets and liabilities. We also look at a P&L account to find out how much money was generated from operations. This is how fund flow statement is prepared. We will also solve some example which will make it more clear to you. Now, this is how funds from operations is calculated. Now, if you compare it with a cash flow statement, in cash flow statement we used to calculate the cash from operating activities. This is very similar. Here we are calculating funds from operations. So, we start with net profit after tax, adjust for non-cash items like depreciation and also adjust for non-operating items. Only difference is in cash flow statement, we also used to have third adjustment for working capital items or current assets and current liabilities. In this case, that third adjustment is not there. So, we adjust first two things and what we get is nothing but funds from operations. In case of cash flow statement, a separate statement known as statement of changes in working capital is prepared. This statement gives us what are the items which have led to increases or decreases in working capital. So, we start with current assets. As you can see here, stock, debtors, cash, they are compared for 2 years and we see the increase or decrease. We also take current liabilities, again look at increase or decrease. The total of all these items tells us what was a change in working capital. This is, you can take a look at the final fund flow statement. So, we start from fund from operations. So, fund from operation is one of the important flows. Here we are first listing out all the inflows, then decrease in the working capital. So, if the working capital has gone down, that means the money is released. So, that is also an inflow. Then sale of fixed assets, sale of investment, these are the inflows. Issue of shares because money is received. If there is some non-operating income like say interest received, that will be an inflow. Loan received will be an inflow. So, this is an example of various inflows. Now, take a look at outflows. In case of outflows, we look at loss from operations, increase in working capital. because when the working capital increases for the business, the long term money is invested and working capital increases. So, it is treated as an outflow. Then naturally there is a purchase of fixed asset, purchase of investment. If you redeem the shares or if you say pay dividend, they also represent outflows. So, let us go back. So, fund flow statement on one side lists out the inflows and also lists out the outflows. We have to see that the total inflows match the total outflows. So, this is a brief about fund flow statement. Now, let us try to solve a problem which I think will make you more clear on what is fund flow statement. So, this is a balance sheet of Reliance Industry for the 2 years. If you remember, we have solved for the same company a problem on cash flow. We will also try to solve a problem on fund flow so that you can also make a comparison. So, this is about the balance sheet. Have a look at all the items first. Okay. Now, it starts with sources, applications and some extract of P&L is also given. Now, when you try to solve fund flow statement, you do not have to mark items as OIF because there is no categorization. What we will do is, we will simply mark the items as inflows or outflows, and if any item has an impact on fund from operation or item has an impact on working capital, those required to be separately marked. So, we will make 3 statements. First, we will make a statement for fund from operation, second we will make a statement from working capital, and then we will finally make the what is known as finally the funds flow statement. Okay, let us look at one by one the items. The first item is equity share capital. You can see there is an increase in the capital. So, what does it represent? Is it an inflow or outflow? I am just trying to find the difference for all the items. So, does it represent inflow or outflow? Pretty common sense. I have issued shares. So, definitely it represents an inflow. I hope everyone is clear about it. So, I have marked it, already marked it as I because it represents an inflow. Okay, is it clear? Okay. Next is reserve. There is a decrease in the reserve. So, it is an item going into FFO. FFO is fund from operations. That is why I have marked it as FFO. Secured loan, there is an increase in secured loan. Is it an inflow or outflow? It represents an inflow. I think I will write in full to make it more clear to you. Unsecured loan, there is a decrease in unsecured loans. So, loans have been repaid. They were 63, they have gone down to 50. So, it represents an outflow. Are you getting clear? Have a look at items once again. So, you can see that what we are trying to do here is, we are simply marking all the items as inflows and outflows. We are not categorizing it. In case of cash flow, we had to mark them as OIF and also as inflows and outflows. Here we are simply writing them as inflow or outflow. So, first item equity capital was marked as inflow. Reserves actually are neither inflows or outflows, but they represent the money coming from operations. So, it was marked as FFO. Secured loan is an inflow. Unsecured loans, the balance has gone down, so it is an outflow. Gross block, that means increase in the fixed assets. So, it represents an outflow. You must have correctly guessed because increase of fixed assets is only possible if I pay money. So, it is an outflow. Accumulated depreciation. So, the depreciation has been accumulated. In other words, it should be marked as FFO. It will have some impact on the funds but it is neither inflow nor outflow. Net block, that means gross block minus depreciation, it will be what? Inflow or outflow? Nothing, simply mark it as XX because it is neither inflow nor outflow. Investment, you can see the investment balance has decreased from 20 to 19. So, it is an inflow, the money must have come in from sale of investments. Inventories, that means the closing stock, the balance has increased, it is a working capital item. So, I will mark it as working capital or W cap. Sundry debtors, again it is a working capital item. Cash, again it is a working capital item. So, whatever is a current asset and liability, we are going to separately mark it. Total current assets, it is nothing, we have already considered these as assets separately. Loans and advances, what I should take? It is also an working capital item. Mind well, it is slightly tricky. By reading the term loan, sometimes you may feel it is something to do with loan received. That is secured and unsecured loan, which we have already recorded. Right now, what loans and advances we are talking about are the advances given to employees or to customers, etc., which are day to day in nature. So, mark them as working capital. Total CAs, it is just a total, so mark it as XX. Now, go to current liabilities, it is a working capital item. Provisions, can you guess? Again, it is a working capital item. Total is nothing, it is XX. Net current assets also XX. Total assets, of course, we ignore them. So, we have marked all the balance sheet items as inflows or outflows. Then contingent liabilities and book value you do not have to consider at all. Now, go to P&L account. As you know, most of the items of P&L we do not consider, but if you feel any item is important, we should look at it. Now, sales turnover we will ignore, excise duty we should ignore, net sales of course we ignore. Other income shall we consider? We should consider, it is an inflow, money is coming out by way of interest, etc., and it will also have impact on FFO. Raw material ignore, power ignore, employee cost, other manufacturing, selling we all ignore. But interest, since it is a cost, interest paid, so I will have to mark it as O. O here means outflow, and it will also have an impact on FFO. So, here we have tried to mark all the items. Now, let us, based on this, let us try to make a cash flow, fund flow statement. Now, what we have to do for fund flow statement is, based on inflows and outflows as we have marked, simply list out the inflows, outflows and take total of working capital items and calculate the fund from operations, and then those items will go into the main calculation. I think we will stop here, and next session we will try to complete this, but I will request you to try it on your own to make a fund flow statement. Thank you so much.